Welcome to the Festival of Entrepreneurs, recorded live at the NEC in Birmingham. Over the next few minutes, you'll hear from some of the most incredible founders, investors, and business leaders who joined us this year.
Thanks everyone for coming. Quick bit of background about who I am. So I'm a qualified accountant. I've spent most of my career in corporates, FTSE 100 size companies. I've done probably most things on the debt and equity stage, from raising corporate debt through to preparing a business for an IPO and taking a business through IPO. I've had roles across the globe, and I'm going to come back to the picture. So rather than a picture of me in the boardroom, there's a picture of me sailing. And I'm going to come back to that very picture and that very day at the end. So it's a really nice analogy to when you're getting your business ready for finance. I now work as a fractional CFO for the CFO Centre. What that means is we can come into a business and we don't do a full-time role. We might spend a day a week or 3 or 4 days a month or 2 days a week, depending on what the business needs from a strategic CFO type perspective. Okay, I've had a few conversations today with entrepreneurs about the sort of capital that they need and why they need capital. And I always boil it down into these 3 areas. Growth. You've had your idea, you've started your company up, and you need to get it to that next stage, but you don't have the capital resources to do it. That's where you might need some external funding. Resilience. We've just heard about interest rates going from 0% to 4 or 5%. That has caused strain for businesses, particularly small businesses that might have variable type interest rates. It causes strain on working capital. So resilience, having capital to hold the business up in times of lean, is really important. And then the big one at the end is transformation. That might be taking the business out to a new market, it might be selling it, it might be floating on the stock market, something really big that you need investment for. When you're looking at this from a CFO perspective, it's slightly different to how you might think about it as the owner and the entrepreneur. You've got the idea, you've got that brainwave, that spark of inspiration, that you've got that idea that's really going to fly. And you might have this plan that you are going to be the next Amazon by the end of next year. Well, where the CFO comes in is helps to put a structure and a plan and some realism behind that as to how you can actually get there. So where are we today? What is the business aiming to do? And then to bring the control framework around that and how we're going to fund it and fund it sustainably. I always think it's important to think about the type of capital that you need. So I always think about it as short, medium and long term. And the different types of capital available lend itself to those 3 time horizons. So over the short term, and by short term I mean a few months, you've got overdrafts and trade finance. You can put those in place very quickly and they can get you through a small blip and a small hurdle. Medium term, you can go to your bank for a loan. You can raise corporate debt. I'm going to talk about each of these in a bit more detail on the forthcoming slides. And then longer term, the end goal where a lot of people want to be is to sell the business, cash in on all of their years of investments, maybe to another investor, maybe via an IPO, and that's where a lot of business owners ultimately want to get to. So short term, I'm going to give a story here. I'm not going to name any names, but I had a small builder come to me very recently in the last year that had a big client that they'd done a lot of work for go pop, and they had bills that they needed to pay, they had suppliers that they needed to pay, and they couldn't pay them. Could I help them get in place some funding with the bank? Well, the worst time to go and get funding from a bank is when you haven't got any money. Right? It's a bit like the analogy of, you only get given an umbrella when it's sunny. It's not when you need it. You need it when it's raining. So what I did with this particular builder was put in place an arrangement with one of their suppliers to delay and to spread their payments over a time while they got back on their feet. And then I said, look, you've got to get in place some form of flexible overdraft facility, some form of flexible drawdown facility in case this happens again. So that's just short term, ideal for smoothing your cash flow. Corporate debt. This is when you go to your banks, you go to the big capital houses like Quillam, going bigger than that, JPM, Deutsche Bank, and you ask them to lend you money on terms, it might be a fixed or a variable interest rate for a defined period of time. And what that gives you is it gives you the cash up front so you can make your investment and you know what your outgoings are going to be. Now they often come with something called covenants. A covenant is a hard requirement that you have to fulfill. So it might be that you always keep cash equivalent to a certain number of times your monthly interest payments. Right? That's an example of a sort of covenant that a lender might put in place. And the nirvana, the IPO. Now, an IPO or initial public offering is when your shares in your business are put up for sale on the public market. It's a big step. The step before that is private equity finance, where another business or another investor might contribute 25% into your business. The downside is you dilute your ownership, you have a slight loss of control, or you flip that around and you've not got all of your eggs in one basket, you've realised some of your investment and you've got another investor alongside you who can provide insight, experience, and they've also got skin in the game into growing your business. So yeah, that's three different types of funding. I always like to think of it as a bit of a journey. And the reason I've talked through them in that order is this is kind of what you're trying to achieve. When you've got your corporate finance, you're establishing yourself with a credit history. You're making repayments, you get a credit score, and you've got that discipline of working with somebody who wants covenant reporting, who wants regular cash flow statements, and that's building discipline and credibility. You then get to your equity investor. Your equity investor is really pleased that you've had this corporate debt and that you've honoured those funding commitments and those covenants. So they're more likely to give you a better investment once you've had that debt financing than if you had gone to them at step one, because at step one you had no history. And then the culmination of that is the IPO. There might be something else alternative to an IPO that I'll touch on in a minute, but you're not going to do an IPO if you haven't got if you haven't had debt financing and/or some equity finance, because you've got no credibility or track record of working with investors. So the alternative, and this has happened to me. You're going to do an IPO, so you go through a period of 18 months of preparing for that big presentation to investors, hopefully subscribing to all your shares, and if you're on the FTSE 100, which was a listing we were going for at the time, going to the LSE on the first morning of trading and ringing that bell. All right, it's a great experience that you're really hyped up for. And you've spent 18 months doing all of this, you've got all of your accounts signed off to what's called positive assurance. It's a higher level of audit standard than what you do with your company accounts as your annual audit. You've done your cash flow statements, and a trade sale comes in. Another investor says, I'm really pleased, you've done all this work, that's great, we're going to buy the business. And that's what happened to me. We've got all the work ready for the IPO, investor decks were ready to go out, and another investor came in. But for our shareholder, that was a great outcome, because they monetized their investment without having all of the risk of would the sale happen on the public markets, would they get the money they wanted. They had a trade investor come in and said, we will give you X for this business, and they knew what they were getting and they went for it. So often the trade sale is the real finishing line rather than the IPO. Okay, so they're the different types of finance available, when you might use them. What do investors and lenders look for? This really isn't rocket science. If you're going to be going out and asking somebody to lend you some money, you're going to have your basics in order. So that means your accounts are clean, reliable, not just audited. All right, yes, you need your audited accounts, but have a set of accounts that hang together. More importantly than that, have a story and a growth strategy that brings it all together. I mentioned the example about being the next Amazon. An investor is not going to buy that unless he believes the story that you tell him. I've got it on this slide actually. Investors back people as much as they back businesses. And I think this is so important. Unless you can communicate what is in your head and how financially it all makes sense to a potential investor, they are less likely to give you the money. The numbers might look great, they might look fantastic, but can you actually communicate it to them, sell it to them, and for them to really believe it? So I do believe that, yes, you need to have the fundamentals in place, but investors back people, right? And they buy from people. So it's always worth thinking about this. It's a useful checklist to have if you are thinking about funding now or at some point in the future. If you think you may need funding, then start acting as if you've got it now. So get your cash flow forecast in place. Having a really robust cash flow that you can test and that will stand a stress, and you can demonstrate that it will stand stress, is really important to an investor. Why 13 weeks? It's a quarter of a year. Right, the other one that investors will look for is a 12 to 18 month forecast. So you've got two types of forecast. Short term, can you pay your interest payments for the next 3 months? Can you pay your suppliers and your creditors for the next 3 months? And then long term, have you got sufficient capital to sustain you over an entire accounting period, service all of your debts, pay your dividends, etc. Monthly management accounts. Steve and I met with somebody just a week or two ago, and we asked him the question, what information do you get on a monthly basis? He says, I don't get anything. Now, I wasn't going in as an investor, but if I was an investor, that would ring a huge alarm bell for me, because if you've got no monthly MI as to how your business is performing, how can I be confident that you are going to be able to meet your obligations from a funding perspective? Clear KPIs and a growth plan. All right, knowing the important numbers for your business and what drives them and how you're going to make them grow is fundamental. And again, it doesn't need to be rocket science, right? We're not looking for really complex ratios here. If the key number for your business is the number of participants or the number of sales, then that's your KPI that you headline in your KPI pack, right? Don't try and, you don't need to have a complicated, glossy presentation that's got loads of different numbers on. The key numbers that drive your business. And then, the fundamentals. Your taxes are all paid up to date. You've got no ongoing investigations taking place. All of your compliance records, your money laundering, your AML checks, your sanctions screening, all of those business fundamentals have to be in place. I love this phrase at the bottom. If you stay ready, you don't have to get ready, because you've got all of your basics in place. Okay, pitfalls to avoid. These are fairly obvious, but I've seen a few slides around, a few presentations here today. Mismatching the wrong type of funding. Back to my building analogy. All right, you wanted to get a bank loan to get him through, a short-term blip. All right, it was going to cost him an awful lot of money to do that because it's high risk. So think about why do you need the funding, and then what funding do you need? And that brings me, I'm going to go to the last point. Do it early. Don't leave it till the very end. So think about what your need is and put the funding in place. Beware of over-optimistic forecasts. I once did myself out of a role when a sales director had presented a sales plan that he knew would make it profitable, but I knew the sales plan wouldn't hold together. And I had to call it out, and we tested it, and it didn't hold together, and we didn't lose money on that investment. So be wary of over-optimistic forecasts. And then the final point is that third one down. If you end up with an equity investor, so you're in a Dragon's Den type format, somebody's giving you £100,000 to take 25% of your business or 35%, think about what that really means. All right, you are giving up 35, 25, whatever the number is, of your business for that amount of money for somebody else to have input to your business. Now, that input can also be really valuable. All right, I don't want you to go away thinking dilution is always negative, because having that extra experienced investor can bring a perspective and an insight that you might not have on your own. Okay, a closing slide, and I'll go back to that sailing analogy as my final point. CFO, think 12 to 36 months ahead. All right, we're not just interested in can we pay the bills this month. Yes, we need to do that, but really where the CFO comes in is thinks about where do I need to be in the longer term. Know what your cost of capital is. Matthew's back. It's what's current interest rates, Matthew?
At least 4%.
At least 4%. There we go. All right, that might not be your cost of capital, by the way. Your cost of capital is what it costs you to raise money. So if you are going to the bank at a time when you've absolutely got nothing, it's raining outside, the creditors are banging at the door, your cost of capital is going to be a lot higher than if you go to them when the sun's shining, all of your bills are paid, you've got no creditors outstanding, you're going to get a better rate of interest, therefore a better cost of capital. Always raise before you run out. There's a bit of a theme there. I've mentioned this more than one time. And I'm going to tell you my personal story now about the sailing story. Does anybody here sail, first of all? That's not going to work then, is it? So I'm going to have to tell you about sailing as well as capital. So if you're a sailor, you may have heard the expression shortening your sails. Now, what that means is, what it actually means in sailing terms, is we put what's called a reef in. So if you've got a big triangular sail, you've got a couple of eyes in it called clews that you use to shorten your sail in really heavy weather. And the mantra of a sailor is put the reef in before you need it. Because if suddenly you get hit by a storm, you do not want to be crawling around on the deck, standing up at the mast, trying to put a reef in your sail. Now that photo I showed you at the start, that nice sunny day, was actually in the British Virgin Islands about 2 years ago. We were racing and we could see the clouds were coming, and we had a quick discussion as a crew and went, no, come on, we'll risk it. And we didn't put our reef in, and we got hit by a squall. We kept the boat upright. It takes a lot to capsize a sailing boat actually, but it did damage the boat. We damaged one of our sails because we got hit too hard in the wind. And it comes back to this same point here. Always raise before you run out. Always put your reef in before you need it. Right? Try and be thinking one step ahead of the game.
Thanks for watching this special episode from the Festival of Entrepreneurs. Our mission is simple: to help founders and business owners grow faster, think bigger, and take action. And if you were part of the event, thank you for joining us and being part of the community. And if you missed it, don't worry. We'll be back with even more ideas, inspiration, and opportunities to help you take your business to the next level. You can find out more and register for future events at festivalofentrepreneurs.co.uk.